New sanctions have oil prices absolutely ripping. Bad news for the bond market. What if Trump's new sanctions on Russian oil don't just hurt Putin? They ignite a chain reaction that ends up crashing the Treasury market. So here we can see the front month futures contract for oil. It is ripping higher, up 10% just over the past 2 days alone. Now, yesterday, Trump announced new sanctions on two of Russia's largest oil producers, and they collectively account for 5.3 million barrels per day. Not only that, but we had a technical extreme or positioning extreme where CTAs and managed money were both heavily short. And generally, when that happens, you get a sharp reversal. As we can see over the past 2 days alone, oil is ripping higher, up 10%. Now, here is why that matters for the bond market. So here we're looking at the 10-year Treasury yield and the crude oil price. Now, remember, with a bond, the yield is inverse to the value of the bond. As the yield is moving up, the value of the bond is moving down. And we can see over the past 1 year, there is a relatively positive correlation, zero point 0.5 in terms of oil and the 10-year Treasury yield. And of course, energy, including oil, go into everything. You have to put gas in your car to get to the factory. The factory needs energy to produce the good. Then that good needs to be shipped. Well, whether it be by land, by sea, or by air, that transport is going to need energy as well. Then it needs to land and get distributed to the distribution center. Hopefully, you can see why energy is a key input for the price of goods and services and therefore inflation. So here we're looking at the break-even inflation rate relative to the crude oil price, an extremely tight correlation here. However, over the past 12 to 18 months, we have seen the break-even inflation rate, which is a bond market-derived rate of inflation, we have seen that move higher despite the fact that oil prices have moved lower. And that is probably due in part to some of the fiscal concerns, of course, and financial repression, risk, and all that sort of thing. So here's why this matters so much for the bond market. So here we're looking at the rate of change of crude oil in green. That is the annual rate of change of oil prices. Then we're looking at the inflation rate. Remember, that number you hear reported on the nightly news is a rate of change. We can see an extremely tight correlation between the rate of inflation, that CPI rate of inflation, and the rate of price change in underlying oil. We can see that over the past 1 year, it has a correlation coefficient of 0.8, a very, very positive correlation between the rate of inflation, the rate of those consumer prices, and of course, oil, the rate of change of oil prices. Here we're looking at another aspect of the problem. So, of course, the first problem is that higher oil prices lead to higher inflation. Well, what does higher inflation lead to? It leads to the Fed hiking interest rates and tightening monetary policy. Of course, that means higher interest rate. Here is the other part of the problem. So, here we're looking at the US 10-year Treasury yield, the dollar yen exchange rate in white, and then in blue is what's called an interest rate differential. This is the difference between what you can get on a 10-year Treasury yield and what you get on a Japanese 10-year JGB. We can see a pretty tight correlation here between these. And the reason here is because when 10-year Treasury yields rise due to Fed tightening or stronger economic data here in the US, the interest rate differential widens and Japanese government bonds become less appealing. Well, that makes US assets more appealing. The dollar, first you have to buy the dollar, sell the yen. Now that you have dollars, of course, you can buy those Treasury bonds that are so much more attractive. So this foreign angle is super, super important because here we can see the globe and then who relies on imported energy. For example, Japan, 87% of their total energy use comes from imported fossil fuels. And of course, we can see Europe and China are also a very large energy importers. And this is the other part of the problem for the bond market. So here we're looking at the price of oil in red pushed forward by 9 months. The Japanese current account inverted. So as the white line is moving higher, they're moving toward a current account deficit. Now, remember, the current account is mainly your balance of trade or your trade balance. As you are running a trade deficit, you generally speaking are going to be running a current account deficit. So as the price of oil moves up, Japan, very, very strong economy. They don't really ever run, at least in the past 20 years, they have never really ran a current account deficit. But we can see that a higher oil price does push their current account surplus less positive. So it doesn't push them outright into deficit, but it does create a funding stress for them. Remember, you have to fund these deficits somehow, whether it be a fiscal deficit, people buying your bonds, as in the case of the US, or your current account deficit, which of course is balanced by foreigners buying your financial assets. You have to balance your deficits, you have to fund them somehow. And we can see, of course, oil moving higher puts funding stress on Japan because it pushes their current account closer toward a deficit. And then in green, of course, we can see import prices heavily correlated to the price of oil. Now, not just Japan, who of course used to be our largest creditor nation. They held $1.2 trillion of US treasuries. Of course, due to that current account surplus, they accumulate national savings. Well, a huge portion of those were in US treasury bonds. But it's not just Japan. Here we're looking at India, and it's the same story. As the price of oil moves higher, that pushes India into more of a current account deficit. And of course, remember, you have to fund your economy. You have to make sure your people have energy. They don't necessarily need US treasuries. As Luke Groman always says, you cannot run a tractor or a car or a bus or a train or a plane on US treasuries. You need energy. And these countries are structurally pretty short energy. We established 87% of Japan's energy come from fossil fuel imports. So the country, kind of as a whole, is short energy. And what is energy oil prices doing right now? It is ripping higher. So they get kind of short squeezed. And of course, they have to fund that deficit somehow. That leaves less money left over to buy US Treasury bonds. Here we can see the same exact story for France. We can see that their current account gets pushed further into deficit. Now, they get pushed into twin deficit. They also run a fiscal deficit like the UK and like the US as well. They actually get pushed into an outright current account deficit when the price of oil spikes. And we can see, again, tight correlation there between the current account, the oil price, and, of course, import prices, which are heavily reliant on oil. So historically, the DXY dollar index had a negative correlation. So what we've done is inverted the DXY dollar index, and we can see that historically there was a negative correlation between the DXY dollar, remember, which is the dollar relative to other currencies, and the price of oil. And the reason for that is that crude oil is priced in US dollars globally. This is that petrodollar that you have heard about. So when the DXY, the dollar, strengthens and you have a stronger dollar, oil becomes more expensive for everyone else. So remember, the other way to say a stronger dollar is a weaker yen, a weaker euro. And of course, that makes your energy more expensive for the rest of the world that we established is reliant on importing their energy. They don't have, unlike the US, they don't have abundant energy reserves. They rely on importing energy. So as the dollar strengthens, of course, that means their currency is weakening. That makes the energy import more of a cost burden. Well, of course, that can reduce their demand for energy and push oil prices down. However, on the other hand, a weaker dollar makes oil cheaper for those non-US buyers, boosting demand and therefore supporting higher prices on oil from that higher demand. And we can see a negative correlation here from about 1990 all the way up until recently, where it went positive. Now, the reason it went positive post 2019, you had, of course, that rise in US inflation. And what did that rise in inflation in the US cause? It caused tighter monetary policy. And tighter monetary policy, QT, higher interest rates, kind of generally speaking, the Fed is not buying and they are actively selling or letting roll off of their balance sheet US Treasuries. That is a removal on the demand side for US Treasuries, pushing yields higher. And you have them hiking interest rates, which of course also moves Treasury yields higher. So not only that, but also remember, the US used to be a net importer of energy. Back then, we benefited from a stronger dollar because, of course, that means cheaper imports. A stronger dollar means that it is cheaper for us to import. And oil spikes were a bad thing. But now higher oil prices can actually boost. Now that we are net exporter, we have such abundant energy production here in America, part of the US economy. Now, higher oil prices actually boost that energy sector when it comes to profits, tax revenue, employment, and can indirectly support the dollar by strengthening overall US growth. The overall US economy, now that we are a net exporter and we have a more a healthy energy sector, now higher oil prices actually help us to some degree. And this is, of course, also true of other countries, like we mentioned in the video on Russia. Now, the other reason, the third reason why we flip to a positive correlation here is geopolitical tension. So, this will be an interesting part of this to watch. But it was happening at least back in 2022. You had a skyrocketing oil price. Well, that was due to geopolitical tensions in Eastern Europe. Well, because of those tensions, what was getting bid? It was the DXY, it was the dollar. The dollar historically has been that safe haven, had that safe haven status. But of course, we know that recently that trend has started to reverse. Now, maybe the energy sector kind of input, maybe that is enough to offset the erosion of the dollar as a safe haven bid. And maybe the Fed is not going to hike interest rates. It is totally possible, given the debt, given the 7% pro-cyclical deficit, and 23% of interest going 23% of tax revenue going to interest, some of these debt issues. It is totally possible that we are in full blown fiscal dominance already in the Fed, in the face of a higher oil price and therefore a higher inflation rate, might say, you know what, we can't hike interest rates because if we do, we will blow out interest expense, which again is already 23% of tax revenue, over $1.2 trillion per year. That's $3 billion per day. So the Fed might step aside and say, look, we can't come in to hike rates because if we do, that interest expense is going to go up, pushing the deficit up, pushing bond issuance up, and therefore pushing yields up unless they can find new demand. So it is totally possible that we flip back into a negative correlation. It is tough to say. We are very early days. Of course, these sanctions were just announced. And just to finish up here, I want to show here's the 2-year Treasury yield, here's the 10-year Treasury yield, and the 30-year Treasury yield. So we can see rates are up all across the curve pretty sharply. So we will continue to watch this, of course, done a couple videos now on this general subject of higher oil prices leading to higher inflation. That higher inflation, of course, leading to higher interest rates and tightening monetary policy. We can see this is basically a perfect one-to-one correlation, almost the rate of inflation and the crude oil rate of change. And of course, there is that foreign element. We know that foreigners, we rely on them to buy our debt. Well, if they are getting pushed into current account deficit or less of a surplus, they have less money left over to buy US Treasury bonds. So there is a reduction in the demand for US Treasury bonds. We know the supply is going up when it comes to bond issuance. Of course, 7% of US GDP must be issued in new debt every single year. So if these countries have a higher oil price and therefore energy imports, which they need to survive, become more expensive, they have less money left over. Again, they have to fund, like France or UK, have to fund those current account deficits somehow. They're not going to have a ton of money left over to buy a bunch of US Treasury bonds, a bunch of interest-bearing dollars. Of course, now Japan always runs pretty much, even in their weakest moment, they always run a current account surplus, generally speaking, at least over the past 2 decades. But again, they have less money left over. So maybe their Treasury bond demand, maybe it doesn't increase as fast as it was. Well, we know on the supply side, when it comes to the bond market, that is up and to the right. There is no reprieve when it comes to the supply side. So if you start to have an erosion on the demand side, of course, that leads to lower bond prices and higher bond yields. Hopefully this was helpful, and I will catch you in the next one.